In May 2026, people slept on pavements outside Swatch stores to buy a watch. Not a Rolex, not a Patek. A collaboration between Swatch, the brand that makes $10 plastic watches, and Audemars Piguet, one of the most exclusive names in watchmaking. The AP by Swatch Royal Pop. Some people queued for 18 hours. Others paid scalpers 4 times retail before the watch had even launched. Resellers were flipping them on the footpath before buyers had reached the door. The watch world lost its mind, trying to decide whether it was genius or catastrophe. But here is the question nobody asked. The same company that greenlit that collaboration also owns Omega. If you want to understand what is actually happening to one of the most important names in watchmaking history, the brand behind the Speedmaster MoonSwatch, the brand on every Bond's wrist since 1995, the only name that has genuinely threatened Rolex's position for over a century, you have to start there. Not with Omega's watches, with Omega's owner. Because the conversation nobody's having isn't about whether the Speedmaster is still worth $6,000. It's about whether Omega has any moves left at all. Go back to March 2022. Swatch Group launched the MoonSwatch, a Swatch and Omega collaboration at $260. Overnight queues formed at every Swatch boutique in the world. Stock was gone within hours. Resale prices hit $1,200 before the sun had set on launch day. By every metric you would use to measure hype, it was a success. But watch what it actually did. The Speedmaster, Omega's crown jewel, the watch NASA chose for the Apollo missions, a timepiece carrying 50 years of earned cultural weight, was now available in a bioceramic case for $260 at a Swatch store, sitting between the airport gift shop and the duty-free perfume counter. The MoonSwatch wasn't a tribute to the Speedmaster, it was the Speedmaster's identity, extracted and sold at a fraction of the price to an audience with no prior connection to what that identity meant. At the time, the community split in half. Half called it brilliant democratization, and half called it brand suicide. That debate has been settled, not by opinion, but by data. Omega watches are not holding value the way they were 5 years ago. The secondary market prices on the Speedmaster have declined consistently since the MoonSwatch era, and you can track it yourself on Chrono24, where gray market Speedmaster listings have sat at or below retail for extended stretches in a way that simply did not happen before 2022. Collectors who built portfolios around Omega are quietly rotating into other names, and the brand that once commanded real premiums above retail is now regularly available at or below it. Instead of pausing to recalibrate, Swatch Group launched the AP by Swatch Royal Pop. That tells you exactly what kind of pressure this company is under. In January 2026, Swatch Group reported an operating profit collapse of 89%. Let that number sit for a moment. Not a soft quarter, not a market correction, 89%. The conglomerate that owns Omega, Longines, Blancpain, Breguet, and Swatch itself watched its operating profit essentially disappear in a single financial year. The causes were real. A slowdown in the Chinese luxury market, a correction in the mid-tier segment after years of pandemic-driven spending, rising costs that volume couldn't absorb, and currency headwinds for Swiss exporters. But what happened next is where it gets interesting. CEO Nick Hayek made a bold call. He announced publicly that Swatch Group wouldn't be cutting its workforce. No mass redundancies, no restructuring of the kind public markets typically demand when profits fall by nearly 90%. He was betting openly that keeping the organization intact through the downturn would position the group better for recovery than dismantling it would. Whether that bet pays off is a separate conversation. What it means right now is that Swatch Group is carrying a full-cost operating structure through a period of dramatically reduced profit, and to sustain that, it needs revenue, consistent, visible, headline-generating revenue, which means it needs collabs. And Omega, whether it wants to be or not, is the most valuable identity in the group's portfolio, the one most worth borrowing against when the numbers are tight. Now look at Rolex. Rolex is private, completely and structurally private. It is owned by the Hans Wilsdorf Foundation. There are no shareholders, no quarterly earnings calls, and no analysts publishing notes about what management needs to do to restore investor confidence. When the gray market for Rolex watches began correcting in 2024 and 2025, Rolex said nothing, changed nothing, and kept production exactly where it was. No press conference, no strategy announcement, no signal at all. They didn't need to. Nobody was voting on their board compensation based on Submariner resale prices. That is not a small advantage. In luxury, private ownership might be the single most important structural asset a brand can have. Scarcity only works when the people controlling supply are free to underproduce without justifying that to a quarterly earnings cycle. Mystique only works when the brand is not required to generate cultural heat on someone else's schedule. Rolex can maintain wait lists that stretch years because no shareholder has the authority to shorten them by demanding more units, and they can absorb short-term revenue softness because there is nobody with the structural power to force a 3-month game instead of a 10-year one. It is worth noting that this is not just a Swatch Group problem. Richemont, which owns Cartier, IWC, and Panerai, and LVMH, whose watch division includes Tag Heuer, Hublot, and Zenith, both face versions of the same structural tension, prestige brands inside conglomerates with reporting obligations. But neither of those groups is running an 89% profit decline, and neither owns a brand with Omega's specific combination of mass market recognition and premium positioning. The pressure at Swatch Group is more acute, and the asset at the center of it is more exposed. Omega can't do any of this. When Swatch Group needs revenue, Omega ships watches. When Swatch Group needs cultural heat, Omega's identity is there to generate it. The MoonSwatch worked commercially, so it happened again. The AP by Swatch worked commercially, so expect more. More collabs, more of the group's prestige brands being borrowed against, more brand equity spent down in the background while the quarterly numbers look defensible. That's not a failure of vision inside Omega. It's the mathematical outcome of running a prestige brand inside a public conglomerate during a financial crisis. And there's no version of that equation that ends well for the brand at the center of it. What makes Omega's position genuinely serious is that none of this is happening in isolation. The Swatch Group trap is playing out while multiple threats close in at the same time, and the structural problem makes it nearly impossible to respond to any of them properly. On one side, there is Grand Seiko. For the better part of a decade, Grand Seiko has been executing something very quiet and very methodical, closing the quality gap with Swiss watchmaking at precisely the price points where Omega competes. The new Grand Seiko Ushio 300 is drawing movement and finishing comparisons from independent watchmakers that do not favor Omega, and it carries none of the baggage. No parent company making decisions above their heads, no public market demanding quarterly signals, just a brand building slowly on craft with the patience that only independence allows. On another side, there is Tudor. Tudor is owned by Rolex, and in the last 18 months, it has moved decisively upmarket. The Tudor Monarch generated over 300,000 views on a single YouTube review within days of launch. The new Black Bay Chrono 39 cleared 70,000 views across independent channels in under a week. It is no longer the affordable alternative for people who cannot reach Rolex. It is a legitimate luxury tier competitor backed by the private financial strength of the most powerful watch company in the world, with none of Rolex's waitlist friction, and pricing that cuts directly across Omega's core range. Tudor has every advantage Omega does not. It can price aggressively without shareholder pressure, take losses while building a position, and move at its own pace with Rolex's money behind it. And while Omega's identity is being borrowed to sell Swatch collabs, Tudor is methodically filling the space those collabs are emptying. There is also an erosion that does not show up in any single data point, but that every serious collector is quietly experiencing. Every MoonSwatch sold at an airport says something to the person who just spent $6,000 on a real Speedmaster. Not loudly, not dramatically, just consistently in the background. It shows up in the gray market data on platforms like Chrono24 and Watchbox. It shows up in the slow rotation of what serious collectors are buying this year versus 3 years ago. It shows up in the conversations at watch events that never quite make it on camera. Here's what the watch industry keeps dancing around. Omega doesn't have a product problem. The Speedmaster Moonwatch is one of the most significant watches ever made. The Seamaster 300M is genuinely excellent at its price point. The coaxial escapement, developed by independent watchmaker George Daniels and licensed by Omega, is one of the few genuinely novel contributions to mechanical movement design in the modern era, and it is a real technical achievement. The META's master chronometer certification that Omega built around that movement sets a precision and magnetic resistance standard that very few competitors can match. The brand's heritage, including NASA, the Olympics, and 60-plus years of bond, is earned, it is real, and it is irreplaceable. If you extracted Omega from Swatch Group tomorrow and ran it privately, with the patience and discipline Rolex applies to every decision, you would have an extraordinary competitor. The foundations of this brand are exceptional, but that extraction isn't happening. Omega is inside a structure that cannot afford to treat it the way it needs to be treated, a structure that needs revenue before brand equity, that needs cultural headlines before collector trust, that needs to show public markets it is moving, even when the right move for Omega's long-term health would be to go quiet and let the brand recover what it has spent. The conversation nobody in the watch space is having, not the dealers, not the gray market analysts, not the creators covering APX Swatch Qs, is whether Swatch Group's ownership of Omega has crossed a threshold, not just complicated the brand, not just created manageable tensions, but whether it is now actively working against what Omega needs to survive the next decade as a genuinely premium name. Omega's problem isn't China, it isn't super clones, Grand Seiko's finishing, Tudor's push-up market, or gray market softness. Those are real pressures and they matter. But every other brand facing those same pressures has a management team that can respond on the brand's own timeline, in the brand's own interest, with the brand's long-term future as the only priority. Omega doesn't have that. Omega has a parent company that, as of January 2026, is 89% less profitable than it was, publicly committed to carrying its full cost base, and looking at every asset it owns and asking what it can generate right now. And Omega is the most valuable asset it owns. That's the Omega conversation nobody's having. And now you've heard it,